The Commodity Channel Index, or CCI, was developed by Donald Lambert in 1980. The indicator is a momentum-based one, and like many other indicators, it helps to tell the user when an asset is in a bullish or bearish trend. It can also be used to judge the direction of a trend, help traders make decisions on their directional bias, or to provide information on whether to exit a trade. In this video, we'll take you through what it is, how to use it, the advantages and disadvantages of doing so. Now, what is the Commodity Channel Index? The index itself measures the current price against the average price over a specified period. So, for example, when the current price is higher compared to its average price over the period, then the CCI will move higher. And the same applies if prices are lower. As you can see on the indicator here, there are levels set at the plus 100 mark and the minus 100 mark. If price crosses the plus 100 mark, it indicates that it is now moving into an emerging bullish trend. And again, the reverse happens if it crosses below the minus 100 mark. There's no upside or downside limits on the indicator, so determining overbought and oversold levels is objective and will require your own research depending on the asset you're trading. One thing to note is that the number of periods to calculate the average price can be adjusted, and I'll show you on my chart here. If I head to settings, I can then adjust the periods that it calculates the average price over. Now, how can we use it? Let's say we're trading the Euro-USD pair. As you can see, I've got it up here on the hourly chart. We have the indicator set up on the chart, and we're using a standard period of 20. As we know, we can use the indicators to determine price trends. So as you can see, I've got a box highlighted here where prices cross the plus 100 level. This would indicate an emerging bullish trend, and we would enter on the close of this hourly candle here. And as you can see, price goes for us. You then choose to exit the trade when you feel that price has turned against you, or the CCI has hit a level where you believe it's overbought, or even when the price turns around and crosses the minus 100 level, which would then indicate the reverse and indicate a emerging bearish trend. We can also use the CCI to show us divergences in price. So divergences are when the price will move in one direction but the indicator will move in another. And I've got another example of that here for you. As you can see, we've got a high on the indicator here and a lower high here, and on the price we've got a high here and another high here. So there's a divergence, and this could indicate a weakening trend. But what are the advantages of using the indicator? As you've probably already guessed, there are a few. To start, it will help you in identifying when a new trend is emerging. Trying to catch the beginning of a move can be extremely difficult, as I'm sure you already know, and a tool to help with that is definitely considered a useful one. You can also use it to identify weak or weakening trends using divergence, as we already mentioned, and this can help minimize losses by providing a reason to exit a position if you see the price move weakening. Of course, with every indicator, there are disadvantages as well. So when it comes to identifying whether price is overbought or oversold on the CCI indicator, as we said before, it's objective, and previous price levels where price may be turned around at a certain level on the CCI, they won't apply in future or current price. And in order to recognize any trends, you'll have to do a lot of back testing on that strategy. It's also a lagging indicator, and so it will sometimes provide poor signals as it lags behind price. For example, the CCI moves above the 100 level or below the minus 100 level, maybe too late as the move has already run its course. As you can see here, price moves below the minus 100 level, but we actually get an emerging bullish trend, and so we would have been stopped out of that move. Finally, there's the potential for many false signals. If the asset is volatile and prone to big swings in price, then it could cause the CCI to provide many potential signals in a short time frame, and we could have a long run of consecutive losses. However, we do still like this indicator, and especially if you're using it with a filter that will help to filter out those consecutive signals and really help to narrow down on entries. It can really help you to be a positive tool in your trading arsenal. That's all from me. If you have any questions, simply pop them in the comment section below. If you want more content, head over to our channel and subscribe, and I will speak to you soon. Take care and have a good trading week.